Hello and welcome back to Global Value. In today's video, we'll be performing a fundamental stock analysis of Chevron Corporation, ticker symbol CVX. At the time of recording this video, Chevron is trading for about $178 per share. They've had a very good 2022 so far, up nearly 52%. Over the past year, their stock price has returned about 71%. Going back 10 years, they're only up 5.5%. They had this big dip during COVID, and then they've been rebounding quite sharply since then. And going back 17 years, all the way back to 2005, Chevron has returned about 7% compounded annually. This compound annual return does not include their dividends, and they are a major dividend payer. Chevron has been in the news recently as Warren Buffett has revealed that it is now the fourth largest position in the Berkshire Hathaway's public stock portfolio. Berkshire Hathaway now owns a little over 8% of Chevron's shares outstanding. So we can see that Chevron is at its 52-week high, which is nearly double its 52-week low. Chevron is a very large business. They have a $350 billion market cap. So what does Chevron actually do? Chevron is an integrated energy company with exploration, production, and refining operations worldwide. It is the second largest oil company in the United States with production of 3.1 million barrels of oil equivalent a day, including 7.7 million cubic feet a day of natural gas and 1.8 million of barrels of liquids a day. Production activities take place in North America, South America, Europe, Africa, Asia, and Australia. Its refineries are in the US and Asia for total refining capacity of 1.8 million barrels of oil a day. Proven reserves at year-end 2021 stood at 11.3 billion barrels of oil equivalent, including 6.1 billion barrels of liquids and 30.9 trillion cubic feet of natural gas. Chevron Corporation was founded way back in 1879 and is based in San Ramon, California. So with that background about what the company does to earn money, we'll be performing a fundamental stock analysis of Chevron. By performing an 8-pillar analysis as popularized by Everything Money, we'll be looking at 8 different financial metrics to give us a holistic beginning understanding of Chevron by looking at their financials. After that, we're going to do a discounted cash flow analysis to try to come to an intrinsic value of Chevron. So without further ado, let's get right into the analysis. Starting off with pillar number 1, we want Chevron's average 5-year PE to be below 22.5. So currently their PE is just under 17, and over the last 5 years, they traded at an earnings multiple of about 17.5. So pillar number 1 is a check to start off. Next up for pillar number 2, we want their average 5-year return on capital to be above 9%. So Chevron's return on capital is very dependent on the price of oil, and because the price of oil has been all over the place in recent years, so has their return on capital. So over the last 5 years, Chevron earns a 4% return on capital in an average year. This means that for incremental money that they're putting back into the business, they're earning below returns on capital. This isn't necessarily the worst thing, as they're starting to put less and less money back into the business, and they're trying to give more and more back to their shareholders. But nonetheless, this is an X on pillar number 2. Next up, pillar number 3, we're looking for 5-year revenue growth. And here we see that. In 2017, they had nearly $127.5 billion of revenue, and that increased to $155.5 billion in 2021, even despite the significant decrease during 2020 due to the global lockdowns caused by the COVID pandemic. So that's a check on pillar number 3. Next up, pillar number 4, we're looking for 5-year net income growth. This is a pretty similar profile to their revenues. They increased net income from $9.2 billion in 2017 to $15.6 billion in 2021, only having a big loss of negative $5.5 billion in 2020. Nevertheless, that's a check on pillar number 4. So far, we have 3 out of 4 pillars. Next up, we're looking at their shares outstanding, and we want them to be decreasing their shares outstanding. So in 2017, they had nearly 1.9 billion shares outstanding, and in 2021, they had 1.92 billion shares outstanding. So not terrible, but there is a slight bit of dilution here as they had to issue new shares during 2020. So this is an X on pillar number 5. Pillar number 6, we're looking for 5-year free cash flow growth. Free cash flow is cash from operations minus capital expenditures. It can be used to pay dividends, buy back shares, pay down debt, make acquisitions, and reinvest back into the business. Free cash flow is this column here in green. So that grew from $6.9 billion in 2017 all the way to $21 billion in 2021. Even though they had negative net income in 2020, they still were able to produce positive free cash flow, producing nearly $1.6 billion in 2020. So this is another check on pillar number 6. By looking at this profile, we can see that their cash from operations has been pretty consistent, and they've been decreasing their capital expenditures, hence the growth in free cash flows. Overall, during this time period, they average about $12 billion of free cash flow in an average year. We'll be using that number when we evaluate how they utilize leverage and how their current market cap compares to their free cash flow yield. So pillar number 7, we want their net debt, which is long and short-term liabilities minus cash and short-term equivalents, to be below their average 5-year free cash flow multiplied by 5. So currently, as of the end of 2021, they have $29 billion of net debt on their balance sheet. Multiplying their average 5-year free cash flow of $12 billion times 5 brings us to $60 billion. So if they're able to have the same free cash flow profile going forward, they'll have plenty of cash that can go to servicing this debt. They'll be in a strong cash generative position financially. So that's a check on pillar number 7. Finally, the big pillar of them all, pillar number 8, we want Chevron's market cap to be below their average 5-year free cash flow multiplied by 20. So Chevron currently has a market cap of $350 billion. Multiplying their average 5-year free cash flow of $12 billion times 20 only brings us to $240 billion. So that's quite a bit off from their current market cap. Therefore, pillar number 8 is going to be an X. In summary, Chevron checks the box on 5 out of 8 pillars. Their only X's came from a below average return on capital, slight dilution, and then their current market cap looks a little expensive relative to their free cash flows. Next thing I want to cover is that Chevron is a very high-paying dividend stock, so I want to look at the health of that overall dividend. One thing that can happen to dividend investors is that they blindly chase high dividend yields, so we always want to check to make sure that dividends are healthy and supported by those cash flow numbers from the business. Currently, Chevron is paying a 3.5% dividend, which is quite a bit above the market, but we want to check their payout ratio, which is the ratio of their earnings to what their actual dividend payments are, to check if this is sustainable. Ideally, we want a payout ratio of below 60% to make sure that a business's dividend payments are sustainable. Here we can see that in a couple of these years, Chevron is really skirting with that 60% threshold, although they did go over it, and because of their big fluctuation in net income, these numbers look really skewed for 2019 and 2020. So I want to take a look at their cash flow per share to paint a better picture here of their dividend profile. As we can see, although their cash flow is lumpy year to year, they actually have more than enough free cash flow per share to pay out their dividends per share. So especially given their year-end numbers in 2021, it looks like this dividend is pretty darn safe. Averaged out over this time frame, they average about $6.3 of free cash flow per share. So while they are paying a lot of that out as dividends, because they're not able to earn high returns on the capital that they reinvest into the business, this is probably a prudent move for their shareholders, as they're able to return cash to their shareholders by paying dividends. And if their stock price is currently high compared to their free cash flow profile, it probably doesn't serve them to commit to that many buybacks. And so even though dividends can be tax inefficient, this doesn't look like that bad of a capital allocation strategy. So that's a good sign for shareholders of Chevron here. Last but certainly not least, I want to perform a discounted free cash flow calculator on Chevron. Any productive asset is worth the value of all the future cash flows that it'll generate from here to Judgment Day, discounted back by a reasonable interest rate. If we can figure out what that value is, then we want to pay a price significantly below that. So the way to do that is to look at their free cash flows and look at how these have grown or shrank over time. We're doing a very rough approximation here, just as a starting point. You can tweak the inputs of a DCF model to get any sort of results you want, but I just want to take one that's a realistic profile based on their last 10 years. This, in all likelihood, won't be the most accurate. However, what we're doing here is we're taking their performance over the last 10 years and we're saying, what is their business worth if that performance is the exact same for the next 10 years? So this is actually an approach recommended by Benjamin Graham. He recommended changing the inputs based on your more nuanced understanding of the business. So we're just going to do the plain vanilla starting approach that he advocated. We can see here that their current stock price is $178. They produced about $13 of free cash flow per share. Now we're adding back in their tangible book value. And because they don't have a free cash flow growth rate over the past 10 years available. We're going to take their book value growth rate as an approximation. So they've grown their book value by 0.5 percentage point in each of the last 10 years. If we run that same model, and then if we have our terminal stage have a 0% growth rate, assuming that their growth stays flat, even though their revenues actually decreased over 10 years, the discount rate that we're able to use, or our rate of return, is about 10% if we would buy the stock today and hold it for the next 20 years or so. And we see that we have a 4% margin of safety here. So the bottom line is that if exactly the last 10 years of the business repeat in its next 10 years, and then it's completely flat from that, you can expect about a 10% return by buying Chevron today. And this return includes all the money it'll pay out from dividends. So this is not the most accurate, and it's probably not that realistic, but similar to our 8-pillar analysis, this is just a starting point. And so this isn't a starting point of what's a reasonable intrinsic value for Chevron. Remember that this is not financial advice, and this is neither a buy nor a sell recommendation of Chevron, merely a starting point. Well, guys, that's it for today's fundamental stock and intrinsic value analysis of Chevron Corporation, ticker symbol CVX. Again, Chevron is a major new holding in the Berkshire Hathaway public stock portfolio. It's their 4th largest position, and one that Warren Buffett himself has heavily added to the beginning quarter of this year. If you enjoyed the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what kind of company you want me to take a look at next. Thanks for learning about Chevron with me, and have a great day.